All right.
Welcome to Stuck Time to Improv. I'm Mary Scott with Business Riff, and I want startups to be wildly successful. Today, we're going to be talking about what kinds of things you should avoid when fundraising. And our special guest is Michael Porteous from NextRound. Welcome, Michael.
Well, thank you, Mary. It's great to be here.
So let's talk. I mean, you're an investor, right?
I am. I've been in the financial markets now for 38 years. There's not a whole lot I haven't seen. Primarily, the business of NextRound is to attempt to connect founders of startups at very particular stages with institutional investors like family offices and venture capital firms.
So this is something that a startup needs to want to scale and want to get in, make money, and get out in order to be meaningful to a family office investor, right?
That's right. And the fundraising exercise is sort of a linear progression. Like you start out the very, very early days with a business plan, maybe a co-founder. Okay, and you got to get started. So the obvious first dollars in could be from an incubator in your community or your friends and family and colleagues. Okay, then you get to work and you start building something. Okay, maybe you get to an MVP or something like that. Then you're usually at that point you're out of money and you go, okay, but like what are the sources of capital out there? Figuring out what the right stage in which to go to the institutional audience is key. A lot of founders go after family office money or even venture capital money too early, and that can be a problem. And so it's great to gather some advice in your community. Maybe you have a mentor who successfully built a company and had an exit. Maybe, as I say, there's a good incubator program. But it's very critical to not attempt to go to the institutional audience until you're at an appropriate stage in your development.
Okay. Do you need to be in revenue before you do that?
Nope. This is a marvelous question. It depends on what you're doing, frankly. Like, for example, if you're building something, say a B2C business, you actually may be able to raise money from your prospective customers along your journey. And you can do that when you're pre-revenue. Okay. On the other hand, if you're building, say, a B2B business, maybe it's a software platform or something like that. Okay. There are many, many, many cases where an institution has funded a business like that pre-revenue. Okay. But let's put some numbers on this. Okay. In the United States, in any given year, about 1 or 2% of startups that are pre-revenue get funded by an institutional investor, a family office or a VC. That doesn't mean that 98% of them don't get funded and die. It means that those 98% have to rely on angel investors, which typically operate locally, or friends and family. Okay. There's a lot of cases lately where you're building something and you have an excellent relationship with your prospective first big corporate customer. Those folks are often a source of funding. In general, it's best to go after the institutional audience when you booked your first dollar of revenue.
Okay. So is there a dollar amount associated with the different levels of investors?
Like in general, first two, maybe 300,000, you should be able to raise from friends and family. Maybe those are 5,000 increments or 50,000 increments. You know, it depends on your ecosystem. Okay. The first quote unquote institutional round could be more than 1 million. Okay. Like if you're a family office somewhere, you have 700 million in assets, you probably allocated maybe 5% to startup ventures. Okay. 35 million. Those guys like to write checks, you know, as small as 250,000 or maybe even 500,000, but they don't like to be alone. Okay. They don't want to be the only institutional investor in there. There's another issue too. The family office guys rarely want to lead around. And leading around simply means that somebody has decided to do all the necessary due diligence, like check you out, and then determine the appropriate valuation and the instrument that you're going to use for that financing. And this is often a chicken or an egg, or like it's a huge dilemma. You find several family offices that are interested and they say, listen, go find a lead and I'll write you a check. And you go after the VCs who often lead and they say, well, go find me some money first and then I'll consider leading.
Right, right. Michael, are there instances when a startup should avoid venture capital?
You should certainly avoid them if like your plan has sort of gone off the rails a bit
Mhm.
and you're out of runway and you're really, really kind of desperate for cash. There's a decent segment of the venture capital community, maybe 20%, that are very, very aggressive. And they're looking to buy an opportunity at a super discounted price. Many times they'll offer you a lifeline. They're going to want 51 or maybe 60% of the company. Okay. So, and that's a danger. Every startup, from business plan on the back of an envelope to building the product to getting to market to generating your first revenue and then scaling. Okay. This entire process, you must pay ridiculous attention to your runway and your immediate cash resources. Okay. Fundraising is a process, not an event. And I hate to say this, but it's usually a continuous and never ending activity. Lots of folks, they get some friends and family money. They say, okay, great. I don't have to worry about this. Then they beaver away and they build their business. And then they notice that they've got 4 months of runway left. And they go, oh my gosh, I have to go to market and raise some money. That is not a good plan. Okay? Because the closer you get to the end of that runway, the more aggressive a potential investor will be on the valuation metric and how much they will demand from you in return from their money.
Right. So it's always a good idea to know your numbers. But I was also thinking in terms of if you don't want to scale your company to sell it, if you want this to be a family legacy or something, you might want to do bootstrapping and not get the angel investors and not even go with venture capital. There are other ways to raise money.
That's good advice, Mary, because why does an angel investor or a family office or a VC write a check? It's to have an exit and get money in return. Okay. These are transactions, right? So when you meet an investor, okay, you have to explain what you're doing, of course. You have to explain how different you are than everybody else trying to solve the same problem. And then you have to give them some sense of what's likely to happen to them as an investor. You give me a half a million today, 5 years from now, the business will be worth 100 million bucks. We'll have an exit, and your 500,000 will be 10 million or something. Okay, that is how their mind works. The founder wants to get the most dollars for the least dilution. The investor wants to give as few dollars for the most stock. Okay, and it's very important to remember this throughout your journey.
Right. And so pay attention to things like lines of credit. If you've got a brick and mortar and you need a new piece of equipment, that might be the way to go, especially if you're already in revenue and can do additional marketing and be in more revenue.
Well, exactly. That there's like in my world, there are startups and then there are scale ups. Okay. When you're a scale up, that is when you want to go after institutional money. Okay. Because a lot of them it can bring a check to the table as well as a well developed network and awful lot of know how. They can act as a partner to you on your cap table to help you scale and grow it. Scale ups are when you'll find an investor, not if. Startups are entirely if. Okay? Like you may not find an investor that totally understands the journey you're on, totally believes in your end game plan and your ability to execute. So prior to revenue, you have to be a very, very careful custodian of the capital you have and just be very prudent that you always have enough time in the pipeline to build what you want.
So the bottom line is do your homework before you pitch to an investor. Thank you so much,
Uh-huh.
Michael Porteous. This has been really interesting stuff. I will put contact information for you into the comments so people can get a hold of you later. And I'm Mary Scott with Business Drift. I want startups to be wildly successful. And one of the best things you can do to accomplish that is book a synergy call with me at businessdrift.com. And join us again next time for Stock Time to Improv.